Let's decode your exact tax liability using the Section 48 computation method.
So, you just sold an asset. How much tax do you actually owe? Let's find out.
We'll follow a simple 4-step blueprint to calculate exactly what you owe. Step 1 is your starting point, the full value of consideration. That's basically your gross sale amount. Next, subtract expenses incurred exclusively for the transfer itself. Think things like brokerage fees. But watch out, any securities transaction tax you paid is absolutely not allowed as a deduction. Subtracting those allowable expenses brings us right down to your net sale consideration. Now we hit a crossroads. Deducting your asset's cost depends entirely on how long you held it.
For short-term assets, simply subtract your actual acquisition cost plus any costs for improvements.
But for long-term assets, you actually get to subtract the index cost of acquisition and improvement. Indexation is a total game changer. It adjusts your original purchase price upwards to account for inflation. The government bases this index on a 75% average rise in the Urban Consumer Price Index. Subtracting those costs from your net consideration finally leaves you with your gross capital gain. Finally, applying Section 54 exemptions can legally and significantly shrink your taxable burden. Subtract those exemptions, and you're left with the final taxable core, your chargeable capital gain. This official pro forma perfectly maps out the entire framework for your exact final tax liability. That's the whole process. So, are you strategically maximizing those exemptions to minimize your final tax?